Hello again. Welcome back to another edition of our valuation series. Today we're going to talk about a company that's near and dear to almost all of our hearts around the world, General Mills. We all know General Mills. We all know the products they make, especially the big ones. Cheerios is probably the most common product that they sell, the most well-known brand they have out there. They also do a number of other ones. I'm on the General Mills website right now, looking at all the brands they have and all the things that they do out there. This comes up as an interesting topic. One of the viewers brought this company to my attention, and since he was the first one to ask about a company to value, I figured I'd honor that and give it a shot. On the surface, it looks like it's pretty much right up my alley. Seems like a pretty boring company. So let's see what they do. So we all know General Mills, and they're a food company. They create multiple food products, baking products, cereals, pastries, fruit ice cream, all kinds of meals and pastas. Just reading down the list here, you guys can read that on your own. But they're into all kinds of different food products. Most of the stuff you see at the grocery store, and we're all familiar with their brands. So there's nothing weird about them that we have to kind of explore what they do. We all know what they do in our everyday lives. They're a fixture in most of our lives every day. Everybody or most people eat a bowl of cereal in the morning. They know what Cheerios are, or they have vegetables with dinner. They know what they do. So I'm not going to go into too much detail about it, but we know the products that they have. So we know them. We know they have a pretty stable business. They've been around for a long time. Let's see if they're a good buy, though. This is interesting coming up now with the current news about Mr. Buffett purchasing Heinz, which was an interesting purchase, but all the clues seem to fit with his modus operandi of buying companies with strong brand names and stable companies that are out there that have that economic moat that he talks about so often. Obviously, Heinz has that. Who doesn't think of ketchup and think of Heinz at the same time? Probably just the 10 people that use Heinz ketchup. So this is going to be interesting to see. General Mills, when I looked at the financials, were pretty similar to Heinz. So if Warren Buffett's willing to pay a premium to acquire Heinz, should we consider paying a premium for General Mills? Well, let's take a look at that and see what we got. So here we go. We got our dashboard here on the old school value spreadsheet as usual. And let's take a look at their financials. We're going to go to the ratios first just to see what's going on here. PE, I usually don't talk about this first, but you can see here that it's kind of swung pretty wildly since the early 2000s. It was trading in the 7s range. Market didn't expect much growth out of them. Then all of a sudden, around 2008, 2009, the market started to pay a little more of a premium for General Mills. Seemingly, their safety came into play around 2008, and people started going into those types of companies, which seems to be a common story out there, that people fled to dividend yielding stocks in recent years, and that they may be overvalued. So that may be the reason why their PE ratio is a little bit higher. So let's go down here. They have some owners' earnings. What are they trading? Owners' earnings 23 times. Price to cash flow 10 times. We go through return on equity. It looks like they have a pretty good return on equity. This seems like it's kind of Buffett-esque, pretty stable in the 20s every year. At 18%, they just nudged lower that year, but in the 20s return on equity, pretty good. Return on invested capital and return on cash return on invested capital. They seem to be they're pretty low. They're not that high when you look at those numbers. They're not a growth stock by any stretch of the imagination. They're not yielding high returns or anything like that. But it's pretty stable. So far it looks like this is a pretty stable company. I always talk about my love of low debt companies and companies that have very little debt in them, and they're very stable in their solvency ratios. So I look at their quick ratio and their current ratio, and I see something a little different. It seems like it's a little bit low. Typically, the classical current ratio is 1 that we want to have out there. But General Mills doesn't have that very often. They have their current ratio over 1 in 2011, just barely, and the rest of the time it's actually below 1. In 2004 it's 1.17. They don't really get above 1 with their current ratio, which means that their current liabilities outweigh their current assets most years, which is typically a concern. But again, if you have a company that's very stable in their cash flow and very confident in their sales, and their sales are highly recurring and stable, you can get away with having a lot less current assets on the book, a lot less current cash and accounts receivable to fund your current liabilities, because you know those sales are coming down the road. So having a current ratio this low is okay when there's a company that has a strong economic moat around their business, a strong brand, and a loyal customer base out there. If you looked at Walmart's is ridiculously low. Walmart's is in like the point 2s, point 3s for these ratios, which is very, very low. But Walmart can get away with that because they know that their sales are very steady and very stable. They don't need to have the cash on the books in case of an emergency. They know they have a lot of confidence in their sales base. So this is okay, just given that we know General Mills and we know people are going to buy Cheerios regardless of the market. You still need to eat breakfast if you eat breakfast in the morning, and you still need to eat in general. So General Mills products are going to be sold in good times and bad, so they can be pretty confident about their sales base. Debt to equity, again, I like low debt companies, but General Mills has some debt on their books. They have long-term debt to equity 0.8. Short-term debt 0.4, so they have some debt on the books. Doesn't look too outrageous, but they do have some debt, and that's okay. An important thing to know about debt is that it's not always a bad thing to have debt. I don't like it on the books. I think it's great when companies don't have debt, but debt can be used as a tool. Debt is a tool like anything else, and if you use it properly, you can achieve great things. If you use it improperly, you get in trouble. With General Mills, they have such a stable cash flow base that I'm okay with them having debt. I look at debt in proportion to how stable I think their cash flow is. A company with more stable cash flow can get away with more debt. A company with very unstable cash flow should have much less debt. So I'm okay with that because I know people are going to continue to buy Cheerios and Wheaties no matter what. Sales are going to be stable. Walmart's going to have a tougher time squeezing them because their shoppers want Wheaties and Cheerios. So they have that type of advantage over their grocery stores, that they have that brand and that customer loyalty out there. So sales should be okay. So I'm okay with their debt being a little bit higher than normal. I'm looking at their efficiency ratios. Cash is a percent of revenue, 4.3%. Receivables is a percent of revenue, 9.8%. I don't look at these in too much depth. I do look at SG&A as a percentage of revenue. How much are they spending on overhead in the company? And it looks like that's been pretty stable over time. So I'm okay with that. That's been their rate for quite a while, around the 20% range. Cash conversion cycle. I looked at this. Thought this was interesting. Day sales outstanding has been pretty consistent. No big deal there. Inventory. Again, this is a food company, so this is a very critical ratio to make sure that their inventory is moving in and out very quickly. I knew an executive at another major food company, and when I asked him about what does the company do to grow, he says it's really about inventory management, and how well do they manage their inventory is going to determine how successful they are. So how much inventory they have on hand and how quickly they can churn their inventory is going to be critical to their success. And it seems like General Mills is, it's in the 50s pretty much regularly. A couple times they bump up into the 60s here, but it's been fairly stable. You don't want to get too out of whack with this, but given General Mills' food nature, most of their foods are based on grain, and the perishability of the grain products is not like a gallon of milk where it's going to go bad in a month and it has to be in and out of the store really quickly. So their food can get away with a little bit more of that. They do have some lines that's not quite the case where it needs to move a little bit quicker, but for the most part it's okay. and their inventory has been pretty stable, so I'm okay with this. Now we look at days payable outstanding. So back in the early 2000s, they had a days payable outstanding of around 60, which means they were getting away with paying their vendors in 60 days. Now, you look at it, all of a sudden in 2007, that dropped massively. It dropped down to 35, in the 30s, and close to 40 now for the last couple years. This is important because now they have a cash conversion cycle that's significantly higher now. They used to be turning their inventory or their cash into inventory, into a sale, which turned into a receivable, and then paying it out. They were paying it out 28 days earlier than they were getting cash in on the sale. Now it's up in the 50s, which constrains their cash management position a little bit. And I found this interesting on why this would happen to a company like this that's been so stable. Why aren't they getting those 60 term days out there? And it's probably because their vendors. I honestly, I don't know. I don't know why their payables dropped like that all of a sudden. Then it leveled off. I don't know what event triggered this where all of a sudden their vendors required payment that much faster. Something with the economy around this time may have happened. I don't know, but their cycle seems to stabilize at this point. So it seems like it's okay, and we can go with this 50-day margin. But it was just interesting to see that drop all of a sudden and then level off. Receivable inventory turnover, those are just different ways of saying days sales outstanding and days inventory outstanding. The long-term debt structure, we looked at this already. Long-term debt, 31% of invested capital. Short-term debt's 15%. So it looks like total debt would be around 47%. So half of the business, half of the invested capital is coming from debt, looks like. Let's go to the statements real quick, see where we're at with that. Again, we're going to start with the balance sheet. They have some cash on the books. Looks like it's been pretty steady. Receivables, again, pretty steady. Nothing too fancy out here. Inventory, that's that critical measurement in a company that's been around this long and is just kind of an old company. Inventory management becomes critical to their success, especially in the food industry. Seems like inventory just kind of is riding along. There's nothing fancy there. We went through that already on the days inventory outstanding. So current assets. Looks like current assets in total haven't really changed much. They've been in the 3 billion range, low 3 billions, and then they jumped up here, but they're not really changing that much. We do have this jump here over the last year from 3.69 billion to 4.5 billion here. We take a look at why that happened. What happened here that's different? It seems like they picked up some cash, which accounts for about 40% of it, and some receivables that they have out there that jumped up another 3.5. So it looks like it's up in the current assets where they picked up some current assets, but nothing too fancy there. It doesn't look like it's moving very much. Everything seems to be in line. Fixed assets seem to be pretty stable as well. So we move into fixed assets. They seem to be pretty stable as well. I mean, another 3 billion here, so they're pretty consistent there. Here's what's interesting though. Most of their assets are in goodwill and intangible assets, and this throws up a big red flag for me. That a company would have this much goodwill in the books as a percentage of its assets. As we know, goodwill is the premium they've paid for an acquisition above the book value. That's not necessarily a bad thing if they're buying a company where the intrinsic value is significantly greater than the book value and they're paying less than the intrinsic value. But when it's such a large proportion of the actual assets that they're getting, it kind of throws up a red flag for me. Of course, they're usually buying pretty well-known brand names that have been around a long time, and the book value may not reflect the true value of the assets in the company. So if you buy a company with a very old factory that may be on the books for next to nothing because they bought it in 1920, but it may really be worth $5 million, when it's on the book.